JPMorgan Private Bank U.S. equity strategist Abigail Yoder is here now at Post 9. Abby, welcome. It's nice to see you.
Nice to see you.
Stage is yours. Just riff on what you're seeing here with the markets and how you're feeling about it. There's obviously a lot of uncertainty around tariffs and so many other things, it seems.
Yeah, well, I think, there's this tug of war between what's going on from a policy standpoint that's creating a lot of uncertainty. But when we think about what's happening from a fundamental standpoint, it looks okay right now. Could the uncertainty from policy, be pervasive enough over the next couple of months that you start to see that come through in terms of hard data? Perhaps. That's not what we're seeing at the moment right now.
Okay, so you are firmly in this is a lot of noise. Look through it and think about what's yet to come, perhaps over the second half.
Yes, and how that translates to a portfolio is we're not changing our U.S. exceptionalism call. I think there's been a lot of attention on what's happening in Europe and China, but that's been a valuation re-rating. You haven't seen anything from a fundamental standpoint, nothing move in terms of an earnings standpoint. It's optimism around, a ceasefire in Europe, and then obviously the AI enthusiasm in China. But until you start to see an inflection in the real fundamentals, be it economic or on the earnings front, it's really not going to get us excited.
That's the thing. I mean, the earnings have hung in there, to say the least. Yeah. Even in the face, in the last week, I think we've had two calls from different strategists taking down their U.S. equity view. You're holding firm, and earnings must be a huge, huge part of that. Yeah, I mean,
the underpinning, so we have a 6,400 year-end price target. The breakdown of that is a 21 multiple, so down.
You're staying with that?
Yeah, staying with that, and it's a down multiple. It's a 21 multiple from where we are today at around 21.7, and earnings growth of 12%. So, unless we see cracks in that, I think, in terms of the earnings standpoint, you feel comfortable with that outlook.
Price action within the market, technology obviously upset. What's your view?
I mean, it's a momentum unwind to a certain extent, and I think this is what happens when valuations are too high, right? Like, this is what happens. It's expectations get higher and higher, and even if they're met to a certain extent, it's like, what's the runway for growth going forward? And this is just, to us, like somewhat of a healthy pullback in terms of technology, and I think it's being felt more broadly because this is what people own, but this is a good call, thinking about diversifying outside of that.
Are you separating the mega caps from some of the other high growth names that have seen an even bigger pullback than the larger cap ones?
Yeah, I mean, because, the previous guest was just talking about the real cash flows. People are going to look for quality. These companies are quality. That hasn't changed. Whether or not the valuation reset is attractive enough for people to come back to them is, I think, the biggest question.
Yeah, I mean, we went through this, when the Fed started raising interest rates, all those non-profitable tech companies really had a big upset. And now, as we are worried about, growth and the valuations for those companies got too rich, we're seeing it again. It's good to catch up with you. Thanks for being here.
Thanks so much.